Howdy doody, folks. What's going on? What's going on? What's going on? I am an associated member of T3 Trading Group, which is an SEC registered broker dealer, and member of the Pacific. Excuse me. All my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. And my position disclosure should be, once again, the same. Radio. What's up? What's up? All right. Where do I start here? So the market's trading down 30 cents from where we closed. We closed green today. The SPY made a new all-time high close today, I think, right? If it didn't, then my afternoon meeting title is incorrect. Did we? Yesterday's close is 88 cents. Today's close is 94 cents by 4 cents. All-time high close. All right. So my meeting name is correct. We are trading down slightly here after hours in the SPYs, but we closed green. The Qs are getting hit pretty hard here after hours. It looks like they closed flat to small red. And the IWM here closed down like 1.25% or so. So the Russell did get hit, but SPYs closed green. I'm exhausted by this afternoon meeting, and I haven't even started it yet because I'm just gonna start rambling about the PPI number and what it means and how crazy, 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 crazy. Everything is so crazy. The market can never go down on anything. It's so crazy. Uh, but that is the fact of the matter. We got AMAT reporting here after hours. AMAT smoked. Let me start with that. Um, AMAT beats on third quarter EPS. They beat on their revenue, but they guided fourth quarter well below consensus. Well below consensus. So the AMAT guide is not good. I don't think, someone correct me if I'm wrong, I don't think that we have seen a single semiconductor or semiconductor related stock go up on earnings this entire earnings season. Pretty incredible statistic. We have not had the most important of them all yet. Sir NVIDIA has not yet reported, but AMD, which was a good report, still traded down on that report. Obviously, it's above that price now. What else? Micron, which is really the end of last earnings season, had a good report, but it traded down on it. AMAT obviously traded down. ARM got smoked. I know that there's others. ON got smoked. It's been one after the next. SMCI got absolutely tarnished. Yeah, every single one has gotten destroyed here, and AMAT is the latest. Yet, despite every single semiconductor stock going down that is reported. Oh, we're still waiting for AVGO also. It's another really important one. Despite every single semiconductor name trading down on its earnings report so far, and AI and semiconductors being the most important area of the market, that has not been able to crack the market. Nor did the PPI today. I got to scroll up and read these numbers out loud because they're that mind blowing, considering the market's reaction today. And I would start by stating what we already know, which is that the PPI's reaction is never as big as the CPI. The CPI, the consumer price index, is always more important to the market than the producer price index. However, when you think about the concept of tariffs and how tariffs slither their way into the economy, it makes a lot of sense that if you're going to see a tariff impact on prices, it's going to start with the PPI, with the producer side, before it actually sneaks its way into the consumer side. And it already has started to slip into the consumer side. That CPI we had on Tuesday was in line with expectations, and the market was very fearful of a hot CPI, so we were able to trade higher on it and actually break out on it. But it did show that consumer prices are increasing. And then we got the PPI today, and uh, the CPI tends to give a much bigger reaction than the PPI, but there has been a couple of occasions ever that I specifically remember the PPI giving a larger move to the market than the CPI. And usually when it does, it's because like the CPI was very boring and nothing happened, so you did not get a big reaction. But then there was like a big miss on PPI that created the big movement. And when you think about the CPI coming out a couple of days ago was pretty in line, but the market was very fearful of that number coming in hot. So we were actually able to trade up and break out on it because of whisper numbers and getting through a fear event without a worst case scenario occurring. This PPI number to me looks like the worst case scenario. I can't imagine this number being worse than this. And I can't imagine. I mean, this number's atrocious. Let me read it out loud. So the core PPI, and core matters more. The core PPI came in at year over year 3.7% versus a forecast of 3%. It came in hot by 0.7%. The PPI month over month, the core PPI, I should say, month over month, came in at 0.9% versus expectations of 0.2%. Core PPI month over month came in hot by 0.7%. The actual PPI, not core, the main headline number, came in at 3.3% versus forecast of a 2.5%. It came in 0.8% hot. And then the PPI month over month came in at 0.9% versus a forecast of 0.2. So same as the core, 0.7% hot. We sometimes sparse through these numbers on like a 0.1% miss or beat here and there and really be like, oh my God, there was a 0.1% miss or beat. Like it's so bad or so good. It's going to have an impact on the stock market. And, I'm exaggerating a little bit, but 0.1% on some of these numbers sometimes can be market moving. Well, numbers I just read out loud came out between 0.7% and 0.8% hot. And we got a big initial reaction. I also really liked the note that Pat put out at 8:46 a.m. this morning. I'll read parts of it here. July PPI print shows inflationary transmission mechanisms are already fully engaged, potentially accelerating the pass through from import costs to consumer prices in coming months, right? That goes back to what I was just saying before. When you think about how tariffs work, it makes sense that you're going to see them on the producer side before you see them on the consumer side. July's 0.9% PPI jump is less a rebound than a warning. Inflation is building up precisely the channels a Trump tariff wave would hit hardest. Trade service margins up 2%, with machinery and equipment wholesaling surging 3.8%. I think we saw another stat somewhere out during the day today. I don't remember if it was an announcement or a stat that showed that the like manufacturing and equipment makers are starting to really struggle with their margins. So it signals disruptors already flexing pricing power. Anyway, upstream diesel plus 11.8% and rising jet fuel making freight costlier, just as tariffs would force longer, less efficient supply chains. Metals are firming up. Supercore came in at 0.6% to 2-year high. It shows that non-volatile business costs are climbing. Even food spikes, vegetables up 39%, raw milk up 9%, illustrate narrow shocks could be magnified by retaliation. Most overlooked, all four intermediate demand stages rose together. Stage 3 goods is up 2%, stage 1 services up 1.4%, leaving no slack in the pipeline. And then it compares tariffs in 2018 to 2019, which had a mixed inflation backdrop. In 2025 to 2026, they would strike a system already synchronized for rapid pass-through. And then finally, it says here in bold, markets treating tariff risk as slow moving, maybe underestimating how short and hot the fuse now is. So, again, just I don't know. Those numbers seem really, really bad to me. And it's going to be now really interesting to see what happens with Jackson Hole. And I know, Jerome Powell. I mean, Jerome Powell. He's Mister Too Late. Let's do a lawsuit against him, Mister Too Late. Like, he's the worst Fed chairman of ever. Blah 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 blah. So, who cares what he has to say? But what he has said, for whatever it's worth, is that the inflation side of the mandate is more important than the growth side of the mandate because you cannot have a stable employment without having stable pricing. He said that like a few Fed meetings ago. And for me, that was it really helped to change my thought process because I agree. First of all, that makes common sense. It's logical. Prior to him saying that, I had a different viewpoint. I thought that the Fed should really, really be starting to cut because getting ahead of the growth side of the mandate, right? As that looks like it's getting set to deteriorate. And then when he said that, I was like, oh, that actually makes a lot of logical sense. Like what he's saying here is how can you focus on employment when we're so uncertain about price stability? And then you get the PPI number that comes out. The CPI number is increasing, right? We are having increasing inflation, not necessarily the end of the world, that CPI number, but that PPI number that came out today was scary. And, the market seems to be still fully pricing in that we're going to get 325 basis points of cuts this year. I don't know. It's really interesting because you now have a government that is applying a lot of pressure on the Fed to deliver these cuts, and we have seen Powell be very, very consistent in being patient in these situations. And if he's got data now in front of him that seems to indicate that prices are beginning to really increase, then I don't maybe we're overpricing in the probability of a cut in September while Powell still is the chairman. At some point when he's done, we're going to put in someone who's significantly more dovish, but Powell still is the chairman and it is still a committee. So I'm sure you're going to get some dissenters if we didn't do a cut, but I don't know. This is starting to become scary stuff, but this is what tariffs do, by the way. Tariffs are low growth, high inflation policies. So you put the Fed in a position where, okay, growth is slowing down. That's a problem. But also prices are increasing. That's a problem. What do we do? But the market doesn't care. That's the craziest part about it to me. The market doesn't care, and the market in and of itself, that the latest Charlie McElligott note, which I think was summarized a bit in Pat's note this morning, it was kind of talking about like the wealth effect a little bit, and how perversely, I mean, this makes plenty of sense, right? If we're already starting to increase on inflation, but the stock market is at all-time highs and you begin to cut interest rates, that even further potentially magnifies the inflation problem. So, I don't know. Turning things over to the price action, because price action is what pays, and I should take my economic theory and just throw logic in the garbage because it seems that that's what the market does every day. We got a really hot PPI, and the market got hit down really hard on it appropriately. I think that was a big surprise. I don't know anybody that was expecting a PPI to come out like that. Again, to repeat myself for the fifth time, PPI does not give as big of a reaction as the CPI does, but that number was hot, hot, hot. We got hit down from a starting point of 655 in the SPYs to a reactionary low of 641.50, right? That first reactionary low is always important, and the starting point is always really important. Like I say it all the time. Make note of the starting point. If you negate the starting point, the market says the news doesn't matter. And also, we wanted to make note of two other key levels for the SPY. One is SPY 640, which is the level that we last broke out from, and the other is SPY 636, which is the starting point of the CPI. Because with the weakness that was coming from the PPI, the question for me wasn't, are we going to make all-time highs today? The question for me was, is this enough to get us to break some support levels on the downside? Answer to that question is that we didn't break a single support level in the market or in any important stocks to the market today. We tested them in AMD, we tested them in Nvidia, we tested them in Palantir. None of them broke. And the market never broke support, never even tried to go after 640. It was too busy going after all-time highs. So we get this initial hard reaction down, we get a bearish consolidation, the ADMA catches up to it. I love this pattern here, right, by the way, especially given the news that occurred. I love this pattern to try to short. It would have failed, obviously, if we broke higher. And then the market opened, and we immediately were trending back up to highs, and we got above the 645 starting point of the PPI. And from there, it seemed like it shook the market out a little bit. We drifted a bit lower. Like I got a bit excited again into this down move. I mentioned it when we were making highs, kind of when I was getting off the VTF radio. It's not that unusual to see like maybe an opening rip higher that feeds on itself to the upside as shorts are getting squeezed and momentum chasers that think that they missed the opportunity to buy the dip are chasing the market higher. It's not that unusual to get a big opening upside move, even like through this upside tail that happened at 950, and then maybe you get a big pivot there. The next thing you know, you're testing lows. Maybe that even lasts 30 minutes. Maybe it even lasts 45 minutes. But this bounced for an hour and a half. And that seemed like too much to me, but then we rolled down pretty hard. We kind of tested lows, and then the market just turned into nothing. It turned into drift. Range day that closed at new all-time highs for the SPYs by 0.4%, despite a wildly scary PPI. The Qs were a little bit weaker today, but it's more or less the exact same deal. And the IWM, which is most interest rate sensitive in a lot of ways, it's going to benefit the most from cuts, whereas we know that the Qs benefit most in some ways from higher interest rate environments. The IWM got smacked a little bit, but that's after it went up 5% in 2 days. This is not a broken IWM chart. It didn't even really test its important level, which is 225. 225 on the downside for the IWM is really important. SPY 640 is important. 636 is even more important. And QQQ 575 is kind of important. I would say more like probably more like 572.50 is significantly more important. So same thing. Know your levels. I kind of want to repeat what Pat said, and it may be true. We have OPEX on Friday, which is tomorrow. I have seen now many times in my trading career, we saw it as recently as this February in a very big way, where it seemed like the bearish things are building up, but the market can't break because options, because positive gamma in the market is creating an insulating effect on the market, and then you get through OPEX and all of a sudden you're able to weaken out. Maybe that can happen this time. I don't want to point to that because I don't want to be that bear who is always pointing to the next possibility and the next possibility and the next possibility, when the reality of the fact is today was the next possibility. Today was the reason why we should have broken down, and we incredibly couldn't. Pat also said it on the radio into the close when he took the words right out of my mouth. He was like, After that PPI came in, I really thought today was the day that I'd be able to press downside. And guess what? You really couldn't. We still had a few really good trades. I mean, I actually had a fantastic P&L day considering that the market is flat. And we still had some really good trades, some really good call outs. We did have some weakness in Palantir. The Palantir is held its level, right? 179 to 180 is really important in the near term in Palantir, and it held it, though it did kind of close weak. Maybe we get some follow through tomorrow. I don't know. Nvidia, um, held that 180 again perfectly. We keep ticking below 180 in Nvidia. And again, this is like options behavior in some ways, right? When you think about how positive gamma works, I don't know what the gamma profile, honestly, of the whole market is right now. I don't even know what the gamma profile is of the market, let alone Nvidia. But every time this Nvidia, you can just see it on this 5-minute chart here, going back all these days. Every time this thing ticks below 180, it runs into big buying, big buying every time. It cannot break that level. And, maybe that is options related in this stock, as the spies are also maybe being held up because of the gamma in the market as well. I really don't know. But we'll continue to watch that level. I've been saying the same thing every morning meeting. Let's watch NVIDIA 180. Let's watch NVIDIA 183.50 to 184. Those are the key levels. How NVIDIA breaks, I think, has a massive influence on the entirety of the market. And then, I mean, the only other thing that's like scary to me, as I'm just rambling now, if you're a bear, is that it reminds me a little bit of June in some ways right now, where early June we were getting a lot of bad news that was coming out all the time, but the market was unable to go down. And at that time was for a variety of factors. It was the systematic bid, it was positive gamma. But then when we got into the back half of June, when we got through June OPEX, which is enabled the market to get looser, in the back half of June, we pretty much only had positive news. So we never were able to go down on bad news in the beginning of June because everything was so insulated. But we were able to really break out to the upside in the back half of June when we were able to get good news and the market profile was not as insulated. I'm almost nervous as someone who's on the bear side right now that you could get a similar situation here where we're seeing some bad news come out, but the market can't downtick on it, and maybe we get into next week and good news starts coming out, and the market is ripping higher because PPI is old news by that point. Well, I don't know. We'll see. We'll see what happens tomorrow. We'll see what happens early next week. But Nvidia held support. AMD also this 180. It kind of closed in on it. But 180 was holding like a champion all day today, so couldn't get any additional follow through on that. My best call out of the entire day, honestly, was calling out the AMD short on the fourth bar here for like a 5-minute RDR into resistance from yesterday. It worked out much better than I would have expected, given that the market continued higher after that point. It started showing relative weakness. It was very strong for the first 15 minutes, and it started showing relative weakness. So that was a pretty good one. It's probably my best call of the day. And Palantir was weak with the Citron stuff and how extended it is and how parabolic it is, but also still really held support. So the question is, know your levels. It's not a question, it's a statement. Know your levels, but the question is, can any downside levels ever break, or is just support going to hold infinitely going forward? I'm inclined to think, when we think about our conditions for a crash, if anybody's got that to repost again, it's like it's the best one ever. When you think about our conditions for a crash, a lot of those 4 points, I think it is, are becoming increasingly present in this market. They could build further. They could definitely build further. But if we could actually get a catalyst at the right time, it is something that could feed on itself. And that CTA cell trigger, level one's cell trigger, is going to keep rising, but the market has been continuing to rise also. So that is all that I've got. Mind-blowing trading session. I still had a great day today. I hope you did as well. And can't help but think how great of a day it would have been if I actually got some follow through on some things. Yeah, there it is from Bill K. Everybody should just memorize this. This is the most important things. This is like it summarizes the most important things. When crash, when crash, in order to have the conditions for a crash, you first need excess length, positioning, leverage accumulation. From what I've seen on that, we have that at least partially, right? We've got that pretty much the systematic community. They're pretty in the pool. You've got that when you look at the leveraged ETF situation. It's as big as it's ever been. It's making new records. You don't really have that when you look at like the long short funds, the more discretionary funds. They're much more neutral still. Back in February, they were at like their 97th percentile before we broke lower. So if you want to just broadly categorize those three groups, you probably have 2 out of 3 that I think have excess length, positioning, leverage accumulation. Next is elements of speculative froth to develop in high beta, high vol market segments. I think we got that. Look at DNUT, look at Jumai, look at Plug running yesterday. You also have a lot of narrow, consistent leadership from these NVIDIAs and Palantirs. Step 3 is, and only then do we get steep skew, where due to set extreme positioning and in high beta speculative sectors and assets, end users then need to hedge downside risk, which in turn means that dealers would be put in a short gamma, short vega position into a spot sell-off, which creates accelerant flow to the downside. My understanding is that that skew has been steepening. And let me just explain this to people who might be newer, might not fully understand what this means. So you're a fund manager and the market is having you become increasingly long for whatever reason. You're getting increasingly long. Well, what a lot of prudent managers do in order to manage risk is they are buying put options to hedge some of that long risk. And when they are buying those put options, and they're buying them specifically because they have so much long positioning, when they're buying those put options, they are steepening skew, right? The cost of puts becomes more than the cost of calls, and they're steepening skew. But what you then have to remember is, so they're hedging their downside risk, but who is on the other side of the fund managers when they're buying those puts? It is market makers, also known as dealers, right? So they are selling those puts to the fund managers that are buying them. But market makers, they don't want to just have risk on how the market moves, right? They're basically just trying to make spreads and they want to be 100% hedged. So what they end up doing is they end up like shorting the market in order to be able to stay hedged on their position. But when these like out of the money puts begin to work, meaning when the market begins to go down, that puts the gamma the market makers have been put in a short gamma position. So short gamma now means that if the market were to break lower, in order for those market makers to continue to stay hedged, they have to sell more and more on the way down, right? So what that does, those market makers will create what McElligott refers to here as an accelerant flow to the downside, right? Right now, what I was just talking about before is in front of this OPEX, we're most likely in a positive gamma environment. When the market goes down, market makers are actually buying the S&P in order to be able to stay hedged. In a short gamma environment, which you could hit at a certain point, the opposite happens, where you get accelerant flow to the downside because the more the market goes down, the more they actually have to sell in order to stay hedged. So I think that we're working on that steepening of skew. So that's step number 3. I do think that, number 1, the excess length and positioning, that could get more extreme. I think the speculative froth could get more extreme. The the steep skew probably also could get more extreme. I don't really have numbers for that. So it could get worse, but it's at the point where I think it could also work. And then here's finally number four, right? Number four. Typically from there, the dealer accelerant flows, we were just talking about, then knock into systematic deleveraging from vol scalers as additional source of synthetic negative gamma in the marketplace. What does that mean? It's the systematic buyers that we talk about all the time, the CTA trend followers, and the vol control community. They have been buyers for months and months and months on the way up, and we know that they are fairly fully in the pool. We know, because this can be modeled, that if you start to see the S&P moving by 1% or more per day on average, you're going to start to see the vol control funds beginning to sell. And we know that if the S&P can get below, I don't remember exactly the number, it's like 62.35 was the latest update from Goldman, I think somewhere around that price. That if you can get below that price, then you also get the CTA trend followers become sellers, right? So what point four here is discussing is how the market feeds on itself to the downside, like how that feedback cycle that I always talk about really comes into play. It is, you get an event that causes the market to go down right as everybody is massively long. So they're going to be potentially selling those long positions, getting stopped out of those long positions. At the same time, because they were to some degree hedged with put options, the market makers are selling into the down move. So that kind of combination creates this accelerant flow to the downside. And then if you can hit the point where you can trigger systematic selling on top of that, from vol controls and from the trend following community, then all of a sudden you've got like the holy grail, if you will, of a market dynamic based sell off where everything is forced to sell all at once. And I would say that if you really go back and you study the market, which we are all students of the market here, you see how the real down moves happen typically so much faster than the real up moves. And that's for a number of reasons. One is from a psychology perspective, we know that fear is a more powerful emotion than greed, right? So when people are fearful, they can run to the exit at the same time. But it's also oftentimes very market dynamic related, right? You hit that point where everybody's in the pool and you can get the accelerant flow and then you can get the systematic community to sell all at once. Then they're all feeding on each other and selling at the same time. And that's when you get the answer to when crash. But you still need something to actually trigger the whole damn thing, right? To get the house of cards to fall in on itself. And usually that's some sort of an event. That event was tariffs in February, kinda. The interesting thing about it was that I would argue to you that there was nothing really new on tariffs that happened between February 19th and February 21st. That rhetoric was already there, but February 20th was OPEX, right? That's why OPEX can be so important. So I was saying before, I don't want to use OPEX as like this end-all excuse of always pointing to the next thing that could be the catalyst that maybe brings out some sort of a bear move. But we do need to note this stuff. It's not surprising. This happens a lot. And it's one of those things I've spoken about many times in the past as well, where I've seen these environments, and for a long time I never was able to rationalize why. Now that we spend so much time studying market dynamics, I can understand why. I understand exactly what happens. But I for years always scratched my head about how, as a student of the market who trades every day, I could watch a piece of news get discussed every day, and then all of a sudden, out of nowhere, after this thing has been ongoing for 5 days or 10 days or 15 days, all of a sudden, out of nowhere, it's like it just decided to matter and the market just crashed. And everybody on CNBC is talking about, well, the market crashed because of XYZ reason. And I'm like, but we knew about XYZ reason for the last nine days. Why did it happen now? And really, it's because of these dynamics that we're discussing. So I don't know. PPI today seemed like an absolute disaster to me. This seemed like a worst case scenario. And that follows through. I guess we had a benign CPI, but it follows through after we had that nasty non-farm payrolls report, which was fake numbers or whatever, probably maybe that was came out whatever that was like a couple weeks ago. I mean, when you combine that PPI with that non-farm payrolls number, I would say things look really, really bad. Maybe the counter argument on that is, well, the CPI was actually fine, and that's really what matters. And those producer prices may not get passed through to the consumer prices, and you're overreading it. And maybe that turns out to be the truth. Time will tell. That's pretty much all I got. I got Bill here giving me some cool charts. 1 month SPX normalized skew for what it's worth. Where were we in February? When that spike before it came down? This has been coming down in the month of August. So maybe that's not there, right? Maybe it's not there. And maybe that's because those fund managers are positioned fairly neutral. I don't know. You got to tell me what you think about that, Bill. And then what'd you give me earlier here? Oh, you gave me NVIDIA. What am I looking at? This is the gamma profile for NVIDIA. Huge positive gamma. Looks like around 185. Where are we on the downside here? I guess this line's around one. So it looks like into that one. It's a little hard to tell because the prices go from 176 to 185. But it does look like there's maybe some like positive gamma around 179 with some negative gamma into it and like in front of it. Still like higher lows. Yeah. Yeah, so that's all I got. Um yeah, so Rock saying everyone seemed a little bit too happy with that CPI print. 0.3% month over month is not light in my opinion. 100% agree with you there, Rock. I just think that I think that we were so scared after the non-farm payrolls number, by we I mean market participants, of seeing like a really hot compared to expectation CPI, that when it was only a little bit bad at 0.3%, which was in line, um, that the market actually went higher as like we got through the event and it wasn't the end of the world. But I agree with you. Inflation is moving up. There is no doubt about it. Inflation is moving up, and I would still say that based on everything I've read from a lot of the earnings reports that we've seen, that we're still kind of at the tip of the iceberg with it. These companies did a phenomenal job for the most part, front running their inventory ahead of the tariffs, and they're only maybe beginning to increase those prices. Show up here, inflation rises faster for categories typically imported. Yeah, I mean, that makes sense. Dennis said something. These tops are always a process, and usually the market won't just give you an intraday top. Yeah, sometimes it does if it's like a parabolic move, like a spot up, vol up move. You get a much cleaner like intraday blow off top. We don't see that happen too often. It's relatively rare. It's giving an intraday top that'll let you hold for weeks. It's just not how it works. Things are always complicated. Otherwise, everyone could make money. There is also simply no need to catch a top or exhaust yourself trying to do so. Yeah, and I agree with that commentary, and we spent a lot of time talking about that recently, about like when we have the catalyst, when we have a market that seems much more bearish, that's when you can be better off pressing downside. Short the lower high instead of trying to short the absolute top. I totally agree with that thought process. I also agree with the thought process from Pat when it seemed like maybe today between the catalyst and the opening weakness that this could have been one of those days. And lo and behold, it really was not. Over in the YouTube from Cyril, given today's IWM reaction to the PPI and price action, you see the potential for downside. The squeeze was shut down today quite hard in Russell, but the market will start to care at some point, right? It's just too early now. The market will care at some point, and I don't think it's too early. We're starting to build up a little bit to the right conditions, like I was talking about. But let's just keep it simple, stupid. Know your levels. Know your levels and see them break. Know your levels and see them break. Did we break SPY 640 today? No, we didn't even test it. Did we break NVIDIA like 180 today? Well, we broke it, but it's really a zone like 179 to 180, and it held. Did AMD break below 180, which was the breakout level that I was expecting to hold as support today? Nope, it held support today. Find me something that's an important stock that didn't hold support today. Did Microsoft hold the support we talked about in the morning meeting today? Yes, it did. Microsoft held the support that we discussed in the morning meeting today as well, the 520 area. Um, let's just keep it simple, stupid. Let's let this market break the levels, and that's it. From Dennis, I tend to exhaust myself before tops, and I am probably not the only one with that experience, for sure. For sure. I prefer to be on the long side of the market. I really do. Being short is so exhausting, and it doesn't feel as good when you win, in my opinion, on the short side. If that matters, no, it doesn't really matter. But like, you're rooting for bad things to happen, and then bad things happen, and you make money. It's not nearly as fulfilling to me as the opposite. Thanks, Robert. From Cyril, do you also look at stock prices adjusted by dollar value? For example, how the US dollar is 10% less than before the February sell-off. I am aware of that information, but I don't because it's not what pays me. Everything I do is in US dollars. I spend US dollars. I travel a lot, and then sometimes I'm not spending US dollars. But outside of that, I know that part of the reason why this market is as strong as it is because it really isn't, right? Part of the reason that we are at the price that we're at is because the dollar is worth 10% less. I thought it was even a little bit more than that than where we were like at the beginning of the year. But I do pay attention to the dollar, right? Almost every morning meeting recently, I've been analyzing whether or not the UUP is above or below 2750 because I think it's an important inflection point. Like at the end of July here, with the way the dollar was rising, at a certain point, that's going to negatively impact the stock market. We also know that there are, or at least were, a lot of people that were short the dollar. You could get a real dollar upside squeeze at a certain point that could negatively impact the market. So I pay attention to that more for what it's going to do to the stock market. But for someone who lives in America and everything he does is in dollars, um, at the end of the day, it's the value of the SPY to me is worth $645, and it's just kind of where we're at. From Benjamin in the VTF, what do I make of the Intel news? It's really bullish for the stock. That would be my keep it simple, stupid answer. If you want, I could get into more of my thought process on how I feel about the U.S. government taking stakes in companies and the erosion of capitalism that we seem to be seeing left and right recently. But I'll keep that to myself unless you really, really want to hear more. Um, but it's bullish. It's very bullish. And that helps semiconductor space too. There's a big level here at 24, 2370 to 24, I think is a really big level. Maybe let's see where it opens tomorrow. Maybe 2250 on a pullback would be a spot to look at. Some like gap support, stuff like that. Want to hear more about that part? Uh, yeah, I mean, I don't know. I think that it's important for government to support industry, right? And kind of guide things along the right path. I am like a real true free market capitalist. I think that that is what creates value. I mean, I do believe in regulation. I think that regulation is the necessary evil to save us from ourselves, but that beyond that, you want to be as close to free markets as possible. Um, and to me, that acts on a global scale at this point when you think about trade and tariffs. Look, it's just the most basic thing in economics ever. Like if you've ever taken like a 101 international economics class, you learn about how tariffs slow down the economy of those who are implementing them, and that they increase inflation. So, like when we saw that headline come out today about Chinese cars, in my opinion, we should open up the United States to Chinese cars. It benefits the American consumer. It benefits the U.S. economy if they have more choice. If that more choice is things that are cheaper, of equal or better quality. You should. The best thing you can do is not buy American, in my opinion, necessarily. The best thing that you should do is the best thing for you, which is to buy the product that is giving you the best quality at the best price for what you're looking for. And that is what will save you money, that creates broader economic growth. That money that you're saving can be invested in other places, it can be spent in other places. It creates a bigger pool of money and larger amounts of wealth. And I don't agree at all with the very common arguments that I hear all the time about, like, well, other countries, they do tariffs. It's like if somebody wants to shoot them in the foot, you're gonna shoot themselves in the foot. Are you gonna shoot yourself in the foot? There's just so many studies out there that show that the EU economy is slower than it would have been otherwise because they overregulate and because of their tariff policies. There's studies that you can read that date back to the 1990s about China versus India. Back in the 1990s, there was a huge debate on who's going to be the big superpower. Is it going to be China or India? Everybody said India because they were a democracy and not China because they're communist. It couldn't have been more wrong. Chinese government embraced capitalism to some degree within their communist government, while India has these massive protectionary tariffs that just hurt their economy overall. Obviously, that's simplistic. There's other things that are going on there. Um, so I mean that's just my thought process on that. And I think that bankruptcy is a really important part, actually, of economic growth also. Like, I know there was some chatter earlier about like GM getting saved. I want to save GM. Maybe the only exception would be something that has such a large systemic risk to the entirety of the economy, like what we did see during the financial crisis when we did end up bailing out and saving those big banks. That might be like the exception. But I was saying it during COVID when we were saving the cruises, and we're saving airlines, and we're saving, we saved General Motors in 2012, or whatever that was. Let them all go bankrupt. Sometimes it's the best thing that can happen. It clears the swamp. It lets new innovation come in. It lets new companies come in, and it lets younger people have the opportunity to be able to buy things that are really cheap. Like, I graduated from college in 2008. I didn't have any money at that point, but if you think about, like, if you were able to get through the financial crisis and survive it and still have some money at the end of it, and you invested in some stocks at those prices, the amount of wealth that you were able to create because the financial crisis actually happened is massive. And it's the same thing in microcosms when you have companies. Let the companies fail, because the competition will come. To If there's demand, competition will come, and then you will have the opportunity to be involved in the early stages of whatever that next thing is going to be that comes in and satisfies the demand, because the cruise company didn't do a good enough of a job managing their debts, or General Motors didn't do a good enough of a job managing their debts, or whatever is the situation that actually leads to the blow up. Let the companies go bankrupt. Like, we have this whole thing now where we're saving all these companies. The cruises one was like the biggest pet peeve for me in the COVID situation too, because we saved these cruise companies, and the cruise companies, most of them aren't even American companies. They're all domiciled in other countries just to not pay taxes and everything else. And then we came in and saved them. It was the most ridiculous thing ever. Let them all implode. It's part of how a strong capitalist society works and how you create innovation. So I don't like that Intel news. I don't like tariffs. I don't like not being able to have choice. I think all of that is at an economic detriment. I get it that national security is important. So, there are certain circumstances where it is worthwhile to negatively impact the economy for the sake of national security. I get it. But otherwise, the whole thing is it's really quite absurd. And even like this, oh, you want to export chips to China? All right, well, pay the government 15% in order to be able to do that. Like that. That's some. I don't know. I don't know. These are socialist policies, not capitalist policies. So anyway, you asked, so I told you. A lot of that is my opinion. So we'll keep it that way. But I try to have my opinions as much as I can based in fact. And I also try to not have an opinion when I don't feel I have enough knowledge in order to be able to create a wise opinion on things. But given that this is what I do for a living, I like to think I have at least some degree of expertise on how economics and markets work. And that's my thought process since you asked. Uh, do I know of any economic books about tariffs? It's funny you would say that. I was randomly going through a bookshelf that I have here in my apartment, and I found a book on tariffs that I think I read in college. That I think I put next to my bed. If you give me 1 second, I'll go find the name of it. Here it is. It's called The Choice. The Choice. A Fable of Free Trade and Protectionism. The author is Russell Roberts. Russell Roberts. And Milton Friedman said it's fascinating. It's a short book, but I remember it really well. And when I found that, I was like, oh, it's so interesting that I just found this, given everything that's going on right now and all these conversations I seem to be having with people about tariffs all the time. Definitely worth a read. The Choice, A Fable of Free Trade and Protectionism by Russell Roberts. EQX looks better since we discussed it earlier this week. It sure does. Sure does. Going, going, gone. All right. Uh, have a great night, everybody. See you all tomorrow.